President Trump has threatened further tariffs on the EU, but how far will the trade war go? Trade conflict is escalating between Europe and the US. President Trump said on Wednesday he'll impose additional duties on the EU if European countries follow through with the tariffs they've announced on American products, including bourbon, jeans and Harley-Davidsons. Those are due to kick in on the 1st of April. Well, Tim Graf is head of macro strategy for EMEA at State Street. Tim, so far these tariffs announced by Europe and the duties that came in yesterday on steel and aluminium are a bit of a rerun of what we saw in Trump's first term, aren't they? So how economically damaging do you think they'll be?
Based on what we have so far, probably not too damaging. So steel and aluminum make up about 4% of EU exports to the US. It's not an insignificant sum by any means. It's about $20 billion worth, I think. It's the potential for escalation and the retaliation that I think is the real risk here. Economically, on its own, it doesn't do too much damage, but it is that threat of uncertainty that looms over how much further this can go.
Yes, and how much further are you expecting it to go? What do you think the market assumes?
I think the market still does assume that this is negotiating tactics and that ultimately there is some negotiated solution. I think there's the potential for reciprocal tariffs, Trump has mentioned, that are probably now being seen as more likely, and this can also be quite damaging. Does the market price for a full-blown trade war of double-digit tariffs on all goods between the US and Europe? I don't think it really has yet. I don't think we're at that point.
What further action might you expect from Europe then if we see these retaliatory tariffs? Clearly, European officials thought, at least until recently, as you say, that this was a bargaining position. But will they then go for tougher options like action against tech companies, for example?
I think so. I think they might try. And there was some commentary yesterday that talked about targeting products that come from traditionally Republican voting states. It's very difficult to know exactly what that means and whether that in fact will be helpful. Europe, as the surplus side of this trade relationship, it doesn't really have a great position of strength to work from in this. They, I think, have more to lose from a trade war with the US than the US does the other way. But I do think they will take on board some of the kind of higher value add US products that do get exported to Europe as part of this, if it does accelerate. I think we need to probably go through a few other steps before we get to that point, but nonetheless, those are the avenues I suspect they would go down.
The other big story in Europe is, of course, the build-up in defence spending. There's a crucial debate in the German parliament today as the incoming government tries to push through a huge borrowing package before the new parliament convenes later in the month. But what do you expect the macro impact to be of Germany borrowing on this scale?
Yeah, I think the dynamic has definitely changed. We started this year thinking that Europe would be going through a period of monetary easing and fiscal tightening. And now what we see is certainly the opposite of that on the fiscal front. And while I suspect we won't hit the heights of some of the maximum expectations people have for fiscal spending, there has been a change. And then on the other side of the coin, the monetary policy dynamic, I think, is far more neutral, perhaps even tighter than markets were pricing earlier. And so the factors have changed that I think, absent a full-blown trade war like what we were talking about before, are much more Euro positive and European growth positive and Germany positive. Germany has the fiscal space, as we know, to enact some of the reforms to its debt brake that are being considered, or at least to spending around the debt brake on defense in the name of kind of emergencies to shore up its own needs for defense as well as those for Ukraine.
Do you think then that bond markets will be happy to buy German bonds issued at a much larger scale?
I think so. Germany's fiscal dynamics are still pretty responsible. You probably do need to see a greater term premium for longer dated German debt. I don't think that's fully priced for some of these fiscal realities quite yet. There is still, I think, a belief that Europe, as it so often does when it comes to fiscal spending, will disappoint. And I don't think they will disappoint. And that additional premium probably does need to be put into yields in the long end. But fiscal balances are pretty healthy in Germany in particular, so I do think the market will take them down, particularly as I think there will be an interest and a need for greater European safe assets to supply to markets.
As you said, Tim, we've seen already a big upside on European stocks and for the euro. Do you think the market is now priced in this spending, or could we see more?
I think in bond markets, as I mentioned before, there's potentially a little bit further to go. That also includes the currency. We track the holdings of institutional investors and their positions in the euro, and they are still very, very underweight. European stocks, on the other hand, they've already closed the big underweight that they held into Q4 last year. Their positions are back to neutral, and price has moved a long, long way. So I do feel like a lot of the good news is in the price in equities, where maybe it's not so much the price on the currency.
That was Tim Graf of State Street. Don't forget, you can watch more videos on Reuters.com.